For decades, Warren Buffett's had this one simple rule for IPOs: just don't touch them. But come on, it's 2025. The market is all about lightspeed disruption and explosive growth, right? So the big question is Buffett's old rule a piece of timeless wisdom, or is it just, well, old? So let's really dig into this. We're going to take apart his entire argument piece by piece and figure out if this classic principle is an anchor holding you back, or if it's the rudder you need in these kind of crazy markets. This is really the ultimate showdown, the temptation of the new versus the wisdom of the proven. Okay, before we get started, the usual quick reminder. This is all for educational purposes, it's fundamental analysis, but it is not financial advice. All right, with that out of the way, let's get to the core of this thing. So, pillar number one of Buffett's argument, what's interesting is it has nothing to do with the stock or the price. Nope, it's all about the business itself. It really just boils down to this one powerful idea: his refusal to invest in what he calls an unseasoned business. So let's break down what that really means. All right, so what in the world is an unseasoned business? Well, think of it this way. It's a company that just can't show you a long history of solid performance, through good times and bad. It hasn't proven it can fight off competitors. It just hasn't been in the game long enough to build what Buffett is so famous for talking about, that moat, a real durable competitive advantage. And right here, this is the absolute heart of the conflict. A value investor, someone like Buffett, they demand proof. They want to see a real, tangible track record. But what does an IPO offer you? Almost always, it's potential. It's a great story about the future. So what's happening is you're being asked to pay top dollar for a dream, not a fair price for a reality that's already been proven. This quote just nails it, doesn't it? I mean, a moat is only worth something if it's actually stopped invaders before, right? With a brand new company going public, you have absolutely no idea if their moat is this incredible defense or if it's just a little decorative ditch that the first real competitor is going to hop right over. Okay, so if the business itself is one big question mark, what about the deal you're getting? That brings us right to pillar number two, the insider's price. And this is where things get really interesting, because we're going to look past the company for a second and just analyze the structure of the deal itself. And what you find is this massive, totally lopsided imbalance of information. It's a really simple dynamic, but it's kind of brutal when you think about it. You've got the seller, we're talking the founders, the early investors, and they know everything: the good, the bad, all the skeletons in the closet. And their goal is simple: get the absolute highest price possible. Then there's the buyer, that's you, the public. And you only get the polished public story. Your goal is to find a bargain. See the problem? Those two goals are just fundamentally at odds with each other. And this is the crucial takeaway here. An IPO price isn't some magic number the market just discovers. Not at all. It is a carefully engineered number. It's designed by investment bankers with one goal in mind: to get the most money possible out of the public's pockets and into the seller's pockets. Think of it this way: it's a sale. It is not an auction. This classic line from Buffett's mentor, the great Ben Graham, it's just the perfect way to look at this. An IPO, by its very nature, demands maximum optimism from you, the buyer. The whole event, all the hype, it's built on excitement for what could be. And that automatically puts the public in the role of the optimist. And that's really the bottom line for this pillar. The seller, who's the realist with all the inside info, is picking this exact moment. This moment of peak excitement and optimism to sell their shares to you. So from a value investor's point of view, you are, by design, on the wrong side of that trade from the very beginning. So let's recap. We've got an unproven business. It's being sold in a deal that's structurally stacked against you. What's the final piece of the puzzle? Well, it's the third pillar, and it's all about the environment the deal happens in, the promoter's hype. This is all about the danger of letting really powerful, high-pressure sales tactics get in the way of your clear thinking. Look, back in the day, this promoter might have been some fast-talking broker on the phone. But in 2025, it is a whole different ballgame. It's a much more sophisticated, much more powerful machine. We're talking about slick, carefully crafted media narratives, insane social media hype cycles, and frankly, management teams that seem way more focused on a splashy launch day than they are on the next 10 years of actually running the business. And what does all this promotion create? One thing: noise, a massive amount of it. And all that noise makes the calm, rational, clear-headed thinking you need for smart investing almost impossible. You're not really analyzing a business at that point. You're just trying to swim in an ocean of hype. So this leads to a really critical question you have to ask yourself. Is this management team really on my side as a long-term owner of the business? Or is their main goal just to create enough short-term buzz to make sure they and their early investors get a big payday? You see, the whole IPO process, it can really mess with people's incentives. Okay, we've looked at the three pillars, the unproven business, the insider's price, and all that promoter hype. So let's go back to the big question we started with. Here in 2025, does this old school strategy still work? Well, the verdict is in. And here's the key insight, the real takeaway. Yeah, sure, the tools have changed. We've got algorithmic trading, information flies around the world in a nanosecond, but the fundamental human incentives, the financial drivers behind an IPO, they are exactly the same as they were 50 years ago. Technology is amazing, but it hasn't changed human nature. When you strip away all the fancy language and the hype, here's what an IPO really is. It's a mechanism. It's a transaction designed to let the people with all the knowledge and all the risk, the insiders, pass that risk over to the people with the least knowledge. That's the public. And they get to do it at the highest price the market will bear. And all of that brings us to a very simple but very powerful equation. In a market that is just completely obsessed with speed, Buffett's whole strategy is about patience. And, in this game, sometimes the discipline to just sit on the sidelines and not play, that is its own kind of power. So here's the ultimate takeaway. The real lasting advantage isn't about getting in on day one with everyone else. It's about having the discipline to wait, to let that same exciting company go out there and prove itself for a few years. And then you wait for the market, not the insiders, to offer it to you at a fair price or maybe even a bargain price during a moment of pessimism, not a moment of peak hype. So I'll just leave you with this one final thought to chew on. In a world that just glorifies speed, that's all about being first, could it be that the simple, totally unglamorous act of just waiting is actually the most powerful and maybe even the most unfair advantage you can have?